For those of you who have read Sheila's book, you'll know that she was not the biggest fan of one big bank, Citigroup. Basically said that they were mismanaged in the run-up to the crisis. They were one of the two banks that needed a big bailout from the government, aside from just the regular TARP program. And there were at various points discussions about whether to remove the CEO, and at that point it was Vikram Pandit. He did not go until he eventually did, and you applauded that. Citigroup's back in the news because their Mexican subsidiary, Banamex, has run into a lot of trouble in Mexico for anti-money laundering, questions about whether they're complying with the law, questions about whether one of their subsidiaries was doing some fraudulent business. And I guess I wonder, it raises a question, are these banks too big to manage? When you have a global bank with far-flung operations across the globe, is it just too much? Is it not the size, but sort of the complexity that's the problem at this point?
Well, I do think, first of all, fraud is very difficult, and we don't know all the facts about whether that should have been discovered earlier or not, but I will say fraud has been a perennial problem. It vexes even the best of managers, it vexes even the best of regulators, so I do think you need to take that into account. I do think Citi's management has improved dramatically. I think they're a much stronger bank, too, than they were prior to the crisis, so I give them that. But they are a very complex organization, and they are managed centrally at the top. And I think that that creates a lot of problems. I know you wanted to ask me about Santander, so I'll just segue into that briefly now. But I recently joined the board of Grupo Santander, a Spanish-based bank that has worldwide operations. But they, like others, BBVA and HSBC are two others, follow a subsidiarization approach where you actually, in each country where you have major operations, you organize that separately. It has its own managers, its own boards, its own standalone capital and liquidity, and yes, you can make mistakes with that model as well, but I do think then you're more of a conglomerate, a collection of smaller regional banks that have their own independent management teams, as opposed to trying to manage everything centrally at the top. I think it's extremely challenging. And as regulators proceed with getting these large banks into resolvable forms and in ways that they can actually be broken up in an orderly way if they get into trouble, making them subsidiarize more not only will improve risk management in the near term, but I think make them much more resolvable in the longer term. So I hope, and this is not a problem unique to Citi. We saw it with JP Morgan Chase. BofA has had its problems as well. And again, that relates to complexity as much as size. You look at Wells Fargo, they're not perfect either, but they have more of a straightforward take deposit, make loans model. It's a simpler institution to manage. So they're starting to get into some of the securities activities too, so we'll see what happens there. But I do think it's simplicity and it's complexity more than it is size. And having more standalone entities that have their own boards and managers, I think, is a way to tackle that problem. If they want, there's some benefits with a global presence. The diversification can help. If the U.S. is having a problem, emerging markets are doing well, you're in a better shape than if you're just in the U.S. But the management challenges are substantial.